There. Standard Chartered Bank, also HSBC, plan to start issuing debt in China very soon as the country opens up its renminbi-denominated bond market. Meantime, the Finance Ministry is due to auction 28 billion renminbi in 7-year bonds today. Talk more about this and how you could potentially cash in. Dariusz Kowalczyk is Chief Investment Strategist at SJS Markets. He joins us live from Hong Kong, And staying with us here on set at our Asia headquarters is Jing Ulrich from JP Morgan. Both of you, good to have you with us, and good morning. Dariusz, let me start with you here. I mean, what we're talking about here is panda bonds. This has been sort of, it's gotten off the ground and just fits and starts. First came up in 2005. What's happened in the preceding time?
Renminbi bonds are becoming increasingly popular because the Chinese government has stopped the IPO streamline in the stock market, which means that Chinese companies have to resort to debt to finance their operations. And so far this year, we have seen a huge issuance of 826 billion renminbi in China of various kinds of corporate debt. Also, Chinese banks in particular have to finance the expansion of loans driven by government stimulus through bonds because they cannot sell stocks. So they have been issuing huge amounts of bonds in China. But now they already increased issuance of renminbi bonds in Hong Kong as well because of the growing pool of renminbi deposit in Hong Kong, where deposit rates on savings in renminbi are lower in China, and therefore it's cheaper for banks to issue here than in the mainland.
Right. Okay. Dariusz, hold that thought. This whole issue of renminbi bonds or panda bonds, Jing, fairly interesting. But, you know, the renminbi is this part of a much longer-term plan by authorities to, at some stage, 5, 10 years out, liberalize the renminbi?
Well, the current plan is to expand the Chinese capital markets. So far this year, most of the expansion in credit came from banks, and also a bond issuance and equity issuance, for example, in relation to bank lending, has been very, very small. So I think the plan going forward is, one, to lift the ban on IPOs for the equity market, and secondly, to expand Chinese bond markets. There's tremendous potential to do that, again, because there's a lot of liquidity, and institutional investors are also looking to invest in Chinese bonds as well, in China itself.
Interesting. Dariusz, back to you in Hong Kong. Let's say the Panda paper issued by Standard Chartered HSBC, are they attractive to you?
I think that these bonds will be probably attractive mostly to Chinese investors from the mainland. Institutional investors from abroad can invest only through the QFII program in bonds issued in China. And right now, the Chinese equity market seems to be much more interesting. So I don't think this is the best time to start. And yet these banks, because they just got permission to do so, will try to expand their capital base through these bonds.
Yeah, you know, we've been talking for the last couple of days about China's budget deficit expected to crack 3% for this year. Is that also part of it, needing to finance that deficit?
Now we are talking about the government debt, and yes, our prediction is that the fiscal gap this year will be 3.1 percentage point, which by Chinese standards is a lot. The Chinese government has been using the bond market to finance this deficit, but interestingly, there is talk about the Chinese finance minister to actually issue government debt denominated in renminbi in Hong Kong, also to tap the Hong Kong renminbi deposit pool. So clearly rising deficit forces the Chinese government to seek new ways to finance it.
Okay, listen, Dariusz, we'll come back and talk more with you. Also, Jing Ulrich from JP Morgan in just a little bit. Coming right up on Squawk this Wednesday morning, we're going to look ahead to the start of trade in Hong Kong, get you some analysis on where trade could go today when we come back. Okay, we're back with Dariusz Kowalczyk, Chief Investment Strategist at SGS Markets, live from up in Hong Kong. And staying with us also is Jing Ulrich from J.P. Morgan. Dariusz, let me get back to you on this whole issue of panda bonds. It's not quite clear yet whether proceeds from panda bonds, whether or not they need to be converted into foreign currency or not. How much of a risk is that?
I believe that currently these bonds are being issued only for the purpose of financing of bank activities in China. So the currency question wouldn't be an issue right now. If it becomes possible for companies that do not operate in China to raise funding there through bonds and then convert currency somewhere else, then the currency risk could become an issue, but as long as the renminbi is maintained relatively fixed to the dollar, that currency risk is relatively low. And because the Chinese government keeps managing the exchange rate very tightly, again, it's a lower risk than in case of other countries.
This is actually quite interesting. Just to supplement that, some of the Hong Kong banks are now allowed to issue RMB bonds in Hong Kong and then use that proceeds to finance their ongoing operations in the mainland. Some of the foreign banks operating in China actually lack funding. They have to borrow money from the interbank market, or they have to attract deposits. This way, the China-based foreign banks, such as HSBC or Bank of East Asia, can actually finance their ongoing operations with money that they raise in Hong Kong. I think there's a big market for this.
Agreed, Dariusz?
Definitely. The issues that are going to come here in Hong Kong with foreign banks selling renminbi bonds to the city-states population are going to be issued actually by the mainland branches of these banks, so far the HSBC and Bank of East Asia, precisely because they are the only natural users of such funds given their branch network in China. So this is only the initial step for the banks that are foreign banks operating in China, trying to raise those cheaper deposits from the Hong Kong deposit pool. You have to remember that, for example, HSBC pays only 0.75% for 6 months deposits to Hong Kong-based residents, whereas in China they have to pay close to 2%. So, you know, they can still attract those Hong Kong-based deposits at a lower rate that they would have to if they try to raise the money through deposit in China. That's why this is so attractive to them.
Interesting stuff. Okay, listen, Dariusz, we got to go. Great to talk to you, sir. Thank you for the time. Dariusz Kowalczyk, live from